Last week, the default response from so many people, before even looking at the numbers and the data, was blame the machines. Blame the machines. Why can we not blame the machines on the price action of last week?
So the answer is, was there some selling by CTAs last week? Absolutely there was. The CTAs came into this move pretty long risk. So long equities, short bonds, short the dollar. And that was the wrong positioning last week. So were they doing some reshuffling of positions? Yes. Did they start the sell-off? No. Did they cause the sell-off? No. Are they part of the volumes going through the market? Yeah, absolutely.
There's a narrative that they exacerbate the sell-off. Can you say they exacerbate the sell-off, the downdraft?
The answer is, if you buy when markets are going down, you decrease the sell-off. If you sell when they're going down, you technically increase it. But why shouldn't you sell positions if you want to change your positions when the market moves? They're not doing it indiscriminately. It's just the same as humans doing it. It's just a thought process of whether you should be, why this sort of everybody should buy a dip, which has become folklore in the markets now. I would say history doesn't tell you buying dips is always the right answer. Really, when vol in the market generally increases, not the VIX, but realized vol.
Yeah.
When volatility increases, you should run less positions. When volatility is low, you can run bigger positions. It's basically about taking the same amount of risk all the time.
So I want to talk about a pickup in vol, and then we'll talk about investor psychology. I want you to help us understand. There's sort of a story out there that when volatility picks up, there's automatic selling from some of these funds into gappy markets. Is it that automatic? Does it literally go, vol's picked up, sell? Or is something else happening? Does it take a period of time for the deleveraging to take place?
So that really depends on the particular models and the particular strategy. So you take the risk parity, which has had a lot of commentary about them as being the big sellers. Most risk parity models use fairly long run realized vol as their input. So yes, when short-term vol ticks up, that makes a marginal change. But for most of them, they're looking at 12 or 24-month rolling realized vol. So it doesn't, the risk parity people really weren't selling very much last week.
So my question to you is whether this has got longer to run. Based on the funds that you run and you oversee, has the deleveraging largely taken place off the back of a pickup in volatility? Or does the deleveraging take a little bit longer from here?
So I think you've got two different effects. That from the pickup in realized vol, yes, the deleveraging has happened. So it generally happens relatively quickly on a pickup in realized vol for the CTAs, much slower for the risk parity. So the two things operate at different speeds. There's a second thing about whether you think markets are going up or down from here. And there's obviously CTAs still have positioning, and that positioning will change depending how the market settles in or this turns into a bigger sell-off.
So many people are going to ask a question based on 2 weeks of price action, whether the funds that follow these trends are sustainable and crowded. Based on 2 weeks price action that haven't performed very well, can you say it's crowded, one, and can you say it's sustainable, two?
So I don't think I'd buy the idea they haven't performed very well, actually. They've been making perfectly good returns in a market. Yeah, they gave, January was an outstanding month, and February's a pretty uncomfortable month and has given back a lot of what happened in January for the index, for the industry.
Yeah.
Okay, that's all right, but on a 2-month move, nothing much has happened. The answer is, CTAs are there to help you in the period when you get extended moves in markets. We haven't yet had extended moves. We've just had something that feels like a regime shift, but from low vol to more normal vol. We haven't actually seen a big sell-off in any sense, right? We're just back to November's price level.
To use your words, feels like a regime shift. Is it a regime shift?
So it feels like, last year was very peculiar with this no volatility around in anything. We know it's the longest period ever without a 3% drawdown in the S&P. And that is very unnatural. Does it feel like we're out of that period? Yes. Does it feel like we're into a big sell-off yet? No. I don't think so. We're into a more normal vol level. Yeah, you've got to think, in normal times, equity vol is a sort of mid-teens number. That gives you 1% moves every day is normal, 3% weeks is normal. Last year was abnormal. The real question, though, is this was all started by an inflation worry 10 days ago.
Yeah.
That you would think would lead to a bond sell-off, but bonds are not changed very much. Right? If we actually get significant inflation, then we are going to see a big sell-off in bonds, and then you're going to see equities have to reprice. Equities are a perfectly reasonable valuation if you assume that we've got sub 3% 10 years. If we get 4% 10 years, equities are not priced.
So just to get your thoughts, Luke, on the market in the respective asset classes, we've had a big repricing on equities now, and the bond market didn't receive that safety bid I would have expected it to get last week. Treasuries just kept in there on the 10-year, more specifically, at around 285. What do you think is the most mispriced right now, equities or the bond market? What are you most concerned about?
So to me, the point where we get a real sell-off in equities, I mean, you know, we had a 10% repricing and we've bounced off there, and it's not a big repricing considering the move we've had, right, to me. And the answer is, when we get a big sell-off in equities, it will be because it's driven by a sell-off in bonds. Bonds will lead equities down the next time. So we haven't yet seen it. The idea that bonds will be a safe haven, I don't really get, because the likely sell-off in equities will come because bonds have to reprice because we've actually got inflation. If we don't get inflation in the next 12 months, you know, with all of the stimulus going on, with, you know, unemployment below heading below 4%, with you know, stimulus going on left, right, and centre. If we don't get inflation then, well, maybe inflation's dead. But if we do get it, you need a repricing in bonds. We have with no more QT coming, there's a lot of supply to come. You would assume that would reprice bonds, and that could reprice equities.
So if we get a correlation pick up between bonds and equity, how much rebalancing do your funds need to do to take account for that?
So that's, again, you have to look at different types of models.
Yeah.
So in some markets, so in a CTA, you treat each market totally independently. So we don't try and predict correlations there. Interestingly, in our risk parity type of approach, we think that you have to look quite carefully at the correlation between bonds and equities. And when that correlation changes, it tells you something about the market. So actually, we got out of the way fairly early before things, just because we saw bonds, equities changing.